Stop scrolling. Stop checking your portfolio for the 15th time today. Stop refreshing that silver price ticker, because what happened in the silver market over the last 4 hours is not a normal correction. This is not profit-taking. This is not some technical pullback. This is an attack, a coordinated, calculated, mechanical destruction of the most explosive rally in silver's modern history. And if you're sitting there thinking this was just market forces at work, just supply and demand finding equilibrium, I need you to understand something right now. Markets don't move like this naturally. Markets don't erase $7 per ounce in 4 hours without someone pulling the switch. Today is Tuesday, January 27, 2026, and this morning, silver touched $117.73 per ounce. That is the highest price silver has ever traded in human history. It shattered the previous record. It broke through psychological barriers that analysts said would take years to reach. The bulls were celebrating, the stackers were vindicated, and then, in less than 4 hours, it was gone. By early afternoon, silver had cratered to $103.89, a drop of 6.55% in a single session, nearly $14 per ounce vaporized. And for those holding leveraged positions, for those who bought at the top thinking this was the breakout, this wasn't just painful, this was annihilation. But here's what you need to understand. This crash didn't happen because silver suddenly became less valuable. It didn't happen because industrial demand evaporated overnight. This crash happened because someone decided it needed to happen. And when I say someone, I'm not talking about retail traders panic selling. I'm talking about the institutions that control the levers of the paper market. I'm talking about the exchange that sets the rules. I'm talking about the banks that have been on the wrong side of this trade for years. They pulled the trigger. And today, I'm going to show you exactly how they did it, why they did it, and what this means for everyone holding physical silver right now. Let's start with the weapon, because to understand how they ended the rally, you need to understand the one tool the exchange has that can stop any market cold. It's called a margin hike, and in reality, a margin hike is a financial demolition tool when deployed at exactly the right moment. Here's how it works in plain English. When you trade silver futures on the COMEX, which is the major exchange for paper silver in the United States, you don't have to pay the full value of the contract up front. You only put down a fraction as collateral. That's called margin. If you want to control one contract, which represents 5,000 ounces of silver, you don't need $500,000. You might only need $22,000 in margin. This leverage allows traders to amplify their positions. But here's the catch. The exchange, the CME group, has the power to change those margin requirements whenever they want. And when they raise the margin requirement, they force every single trader holding a position to either deposit more cash immediately or close their position. And that's exactly what they did. On January 7, 2026, the CME Group announced a massive 47% increase in silver futures margin requirements. They raised the maintenance margin from $22,000 per contract to $32,500. That's an additional $10,500 per contract that every trader had to come up with immediately or face forced liquidation. Now let me put that in perspective. If you're a hedge fund holding 100 contracts, that's an additional $1,050,000 you have to wire right now. If you're a retail trader holding 10 contracts, that's an extra $105,000 you probably don't have. So what happens? You sell. You're forced to sell, not because you think silver is going down, not because your thesis changed, but because the exchange changed the rules in the middle of the game and you don't have the liquidity to keep playing. This is how you crush a rally without firing a shot. You simply make it too expensive for anyone to hold their position. And the timing of this move is not accidental. Silver had just broken through $110. Momentum was building. Shorts were getting squeezed. The physical market was screaming that supply was running out. Lease rates, which measure how expensive it is to borrow silver, had spiked to 8%. For context, normal lease rates are around 0.3 to 0.5%. When lease rates hit 8%, it means the market is desperately short of physical metal. So the exchange saw the train coming. They saw that that if silver kept climbing, if it broke through 120, 130, 150, the entire paper market could implode. Banks that are short silver would face catastrophic losses. So they pulled the switch. They raised margins, they forced liquidation, and they turned a historic rally into a flash crash. But here's what they can't control. They can manipulate the paper price, they can force liquidation in the futures market, they can crash the chart, but they cannot create physical silver. They cannot mine it out of thin air, and that's where the real story begins. While the paper price was getting destroyed in New York, something completely different was happening in the physical market. Let me give you a number that should shock you. While COMEX was trading silver at $111 after the crash, physical silver in certain parts of the world was changing hands at $130 per ounce. In Japan, reports indicate physical silver clearing at $130, in Kuwait, $116. Even in the United States, premiums on physical coins and bars have exploded. The spread between futures price and what you actually have to pay a dealer to get metal in your hand has widened to levels we've never seen before. This is what we call the Great Divorce. The paper market and the physical market are no longer speaking to each other. They're operating in two different realities. And the reason for this split is simple. There's not enough physical silver to meet demand at these paper prices. Right now, the physical market is screaming shortage. COMEX registered inventories, which is the silver available for immediate delivery, have plummeted by over 70% since 2020. Between early January and mid-January 2026, 33.45 million ounces were physically withdrawn for delivery from COMEX. That's 26% of registered inventory in a single week. When you see physical metal leaving the system at that pace, it's a sign that people no longer trust paper promises. They want the real thing. Now here's where it gets even interesting. On January 1st, 2026, China implemented one of the most aggressive export control regimes in modern commodity history. China reclassified silver as a strategic dual-use metal. You can no longer export silver from China without government approval, and only 44 companies have been granted licenses to export silver over the next 2 years. Why does this matter? Because China processes and refines more than half of the world's silver supply. When China chokes off exports, they choke off global supply, and that's exactly what's happening. In Shanghai, physical silver premiums over London spot price have reached $8 per ounce. That's the widest spread on record. Let's talk about the casualties, because when you raise margins by 47% overnight, when you crash the price by $14 in 4 hours, someone has to lose. The most dramatic example comes from India. In the city of Rajkot, which is a major hub for silver trading in India, 44 silver trading firms officially declared insolvency in the wake of the margin hikes and price crash. These firms had combined liabilities of $425 million. $425 million in losses from a single coordinated attack. These were established trading houses that had been operating for years, but they made the fatal mistake of holding paper positions, not physical metal. They were playing the paper game, they were leveraged, and when the CME pulled the switch, they couldn't meet the margin calls. They were liquidated, their businesses were destroyed. And here's the cruel irony. While these Indian firms were going bankrupt, the price of physical silver in India was soaring. They had the right thesis, they just had the wrong instrument. For those of you watching who are holding physical metal, this is the moment where you need to understand your position. You're not holding a paper promise. You're not exposed to margin calls. You're not at risk of forced liquidation. You are holding a real asset that cannot be printed, cannot be rehypothecated, and cannot be seized by an exchange rule change. The people who got wiped out in this attack were the people playing the paper game. The people who survive are the ones holding the metal. And when the dust settles, when the paper market finally breaks, the physical holders are the ones who will have wealth. So if you're holding physical silver, do not panic. Do not let today's price action shake you out. Remember, what you saw today was a paper market attack. It was not a fundamental change in silver's value. The physical market is still tight. Industrial demand is still strong. China is still restricting exports. The supply deficit is still real. What happened today is noise, it's manipulation. And if you sell your physical silver because of a margin hike on COMEX, you're letting the manipulators win. Don't, because every attack makes the physical market stronger. Every attack wakes up more people. Every attack brings us closer to the day when the paper market finally breaks and the real price of silver is revealed. That day is coming. I don't know if it's next month or next year, but it's coming. And when it does, the people holding physical silver are going to be on the right side of history. So hold your metal, ignore the noise, understand the game, and prepare for the end game. The attack happened. Now you know why, and now you know what to do.